I come from the school of value investing, just like Buffett, right? I call myself a Buffett-style investor, but sometimes I'll interchangeably use value investor.
This is the banking in me coming through because I'm like, wow, this is a triple threat, right? Publicity, new accounts, and earnings from interest.
I rarely know what the stock price of a company is.
How Buffett of you. And why not do both? Why not have the experience and also buy $200 in merchandise?
Yeah. When you start studying these things, when you start actually following the money, the chessboard makes so much more sense. Welcome back, friends and flankers. In today's episode, we're going to be talking about the most misunderstood metric in all of investing. And that is, of course, P ratio. Elliot, what do you know about P ratio?
Well, I don't know a lot about PE ratio, but what I do know is about vibes, and I can tell that second episode we're already vibing. Look at us, both in our white shirts.
Yeah. I bought this shirt yesterday, and you can tell it's about 2 sizes too small. But hey, look up the Google David Flank's image search and see what the first response is. I see you guys. Okay, you guys will see the first one.
Get the screenshot.
Yeah.
Yeah. I won't reveal where I got mine just yet.
Yes, that's true. That's later in the episode. Okay, so so what I'm hearing is you don't know anything
about PE ratio.
And you know what? That's great though, because a lot of our audience, there are some people, and listen, because I still got a lot to say, even if you know what it is.
Oh, you do always have a lot to say.
That's true.
Yeah.
But if you don't know what it is, it'll also demystify a lot about investing. So PE ratio. You take the price, which is the stock price of the company. We'll use an example. We'll look at Robinhood right now. The stock price is currently $113, and their EPS is $1.96. So if you divide 113 by $1.96, this doesn't update real time, so don't you math guys out there, don't be cool.
Don't fact check it.
Yeah, but it'll be around 56. So that's what you're doing. You're taking the stock price and you're dividing it by the earnings of the company. There's a difference between cost and a difference between value, right?
No, sure.
So what that tells you is that it's basically your altitude. How expensive is the stock? If I wanted to buy stock in a good non-financial example would be let's imagine that Taylor Swift, the singer, was securitized.
Oh my God.
So you could
buy stock in Taylor Swift?
You could buy
Where
stock
do I sign up?
into Taylor Swift's earnings potential, right? Because that's what you think of a business as. A business is just a cash printing machine, and you want to see how much, is that thing going to produce more cash in the future, less cash, or the same amount of cash? But then you want to know how much you have to pay to buy either partial ownership of that cash machine or all of it.
Oh, sure.
And that's where PE ratio comes in. So Taylor Swift would be a great example. Everyone's super hyped on her. Everyone, she's got a ton of fan base. She's super successful. So if she was securitized, if you could buy stock in Taylor Swift, it's safe to assume that it would be pretty expensive.
Right.
It would be a high PE ratio.
Blue chip top.
She would be
chip stock.
Right. And so, sure, she could do very well in the future, but you're going to have to pay a lot of money just to get that seat at the table. Right. A good example of this, and the best, and the company that I get asked by far the most in whether or not people should buy or sell, which, by the way, I'll never answer that question. You got to do your own research. That's the whole point of why we're here, is NVIDIA, right?
Oh, yeah. Great.
NVIDIA is currently at a $4.44 trillion market cap. That's the most valuable company in the world.
Wow.
And all market cap is literally just taking the stock price, so $1.82 or $182 in NVIDIA's case, and multiplying it by how many shares outstanding there are. So how many shares there are.
Sure.
And so if you multiply those together, then you get, instead of looking at just a slice of pizza, you're looking at the whole pizza. Yeah. The first versions of Flank actually only gave you market cap instead of price up here, and then we got feedback that people wanted the stock price. I rarely know what the stock price of a company is.
How Buffett of you.
Yeah. I know what the market cap is, though. I know the market cap of every single company I've ever invested in, and I could probably name it what it was when I bought it. But Taylor Swift stock, everyone's really hyped on it. Everyone loves it. It's probably going to be pretty expensive. She'd probably have it's blonde. She'd probably have a very high PE ratio. And so then the question is what do you know about the economics of Taylor Swift that could then, what do you know more than the masses? What do you know more than everyone else about Taylor Swift? And if you can answer that question, then you should take a position in Taylor Swift stock. But if you can't, then you should do your homework.
Do your homework, yeah.
But if you look at NVIDIA right now, it's trading at a PE ratio of 58. That means that if earnings were to remain static, it would take you 58 years to be made whole on your investment, which is a long time. But earnings is in the denominator there. That to me is the most misunderstood thing about PE ratio, is that it's a static figure. That's looking, especially this is TTM, so trailing 12 months PE ratio. So that's looking at the last 12 months of NVIDIA's earnings. It's static, so that means that if it's a snapshot, it's not accounting for what they could grow at. If they're growing revenue quicker than that, or more importantly, revenue would trickle down to earnings, but it's looking at net income is the actual number used there.
Sure.
We said EPS earlier on. You can take stock price divided by EPS because EPS is already per share.
Yeah.
But if you just do market cap divided by net income, you'd get the same number.
Okay.
There is a little bit of a difference for the financial nerds in the audience, which I love you, between diluted and non-diluted EPS, but we'll save that, okay? Be cool.
You have to wait. Keep watching for that one.
Yeah.
A couple episodes down.
But that gets into the different flavors of PE ratio. Does that make sense what PE ratio is?
It does, yes.
Yeah, and a lot of dogmatic investors. I come from the school of value investing, just like Buffett, right? I call myself a Buffett-style investor, but sometimes I'll interchangeably use value investor. I actually don't like to use it unless I'm just kind of being agreeable. I don't like to call myself a value investor because value investors are historically very, very dogmatic.
Sure.
If they see a PE ratio greater than 10, that's like untouchable to them. And that's part of the reason why I've seen PE ratio being so misunderstood by individual investors is because, just on its own, it doesn't tell you that much about a company. It tells you what the past earnings have been. Yeah. Or if you're looking at forward, there's different flavors of PE ratio, which we'll get into. But if you're just looking at the that's just accounting for how that company has performed over the last 12 months. So in the case of Amazon, I bought Amazon in 2012 when the PE ratio, let's look at it.
Wow, 2012. That's a long time ago.
Yeah, and I still hold.
Stuff was still cheap on Amazon.
I have added. Yeah, I have
books,
added
cables.
Yeah,
SD cards.
I've added to the position since then. But yeah, it was one of the first stocks I bought. And when I bought it way back in 2012, you can just look here. So they were unprofitable. So when they're unprofitable, right, your PE ratio is going to be 0 or infinity because you can't divide by 0.
Sure. Yeah.
But before that. So this is, I remember it being in the 200s when I bought. So I bought Amazon at a PE ratio of 200. So do I sound like a hypocrite talking about NVIDIA being at 48 and saying that's too high?
Right.
Well, after I took my initial position and I added to it later on, I believed in the company even more so because I read The Everything Store by Bradley Stone, which told me what Bezos' dream was. Started with books and then expanded the offering, right? And now his dream was to create the Everything Store. Right. And then
he's doing a great job of.
Doing a great job, yeah. Hey, buy anything on. But yeah, you could see that the PE ratio went from around the 200s. And then it was even in the thousands. And I bought through this period when it was, a crazy high PE ratio.
Right.
But what it didn't look at was what the earnings growth would be, what the future earnings could be of the company.
Because the denominator was 0 this whole time. So therefore the PE ratio was off the charts.
Or very low because they had such large capital expenditures, which affects your bottom line.
Right.
They were investing in building these massive distribution centers that were cutting edge. My dad worked in the concrete industry in the Chicagoland area, and he couldn't get rebar for his company's projects during this time because Amazon was buying them all throughout the Midwest.
Yeah.
They were buying everything. And they were paying high prices for it. So they knew that they caught a growing industry at the right time, and they wanted pure domination of e-commerce.
Wow.
Now, they'll never say that in antitrust law, but that's because they're corporate snakes,
Right.
But they want pure domination of e-commerce.
Yeah.
And then in 13 and 14, I continued to add a position because the cloud was coming on, and they were the only ones with AWS.
Right.
They were the only ones, and the operating margins on the cloud offerings are insanely higher, right?
Right. It takes so much less to operate that kind of business than like a distribution business.
Oh,
It's
yeah.
So much less.
Yeah, retail is a nightmare.
Yeah.
One of the most chilling things for anyone who's thinking about getting into retail or just wants to study retail businesses, which there's a Bezos quote, and he said He said, your margin is my opportunity. That's the game you're playing when you're playing in discount retail.
So I guess I'll cancel my application to work at Claire's, which is a whole nother
Which just
issue.
Just declared bankruptcy. Yeah.
So maybe another reason.
So that's why it's misunderstood. It's misunderstood because it for a lot of value investors, it's an immediate turnoff. If it's like, the PE ratio is over 20. But really, what Buffett would say and what anyone would say, and we'll get into what Buffett's PE ratios that he bought some of his most famous investments were when he bought them. And you'll see that it's all over the place. Now, valuations matter. And if you can't predict the future economics of the business, if you can't tell this story, I bought Tesla when it was an extremely high PE ratio in 2016. I understood that they were I read the master plan. Master plan said they were going to create a luxury sports car, and they were going to make a premium sedan and a premium SUV, and then they were going to try to make mass market EVs. Yeah. And they had their break,
what they did.
Which is what they did. Yeah. And their pushes into energy storage, their pushes into solar. Right. I just thought that it was a great. And then the first time I rode in a Tesla, I was just amazed by the engineering. I thought it was the iPhone of cars.
Right. Well, the good news is that because you're a shareholder, once the satellites crowd up all the sun coming through the atmosphere, you'll be able to leverage that to get a little sun ray.
Yeah, hopefully
through the satellites.
Yep. SpaceX is SpaceX owns all the satellites, and I do want SpaceX to go public, and they should go public. But Musk has said that he's not going to bring it public until their mission to Mars is more secure, which I do respect. He actually regrets taking Tesla public because 2008 almost killed him. But that's a story for a different day. Sure. Let's go into the flavors of PE ratio. So we talked about PE ratio, and it's called trailing PE ratio. Yeah. So that's looking at the last, if it's TTM, it's looking at the last 12 months of earnings. Yeah. You can get into crazy stuff if you're looking at macroeconomics, where you're talking about CAPE ratios and stuff. We're going to ignore that. We're going to look at just analyzing a single company. But the other form of PE ratio that you'll sometimes see is forward PE ratio. So forward PE ratio, it's kind of a dastardly metric because it's saying it's taking the future earnings over the next year of the company and doing the PE ratio for that. But the question is who's calling those earnings?
Who's telling the future?
And sometimes
who's got the crystal ball?
Yeah, exactly. And sometimes sometimes it's set by the company. They're saying we expect that we will have this EPS over the next 12 months, and you can kind of goal us against that. We're on paper saying that. Those are our expectations. Sometimes they're analyst expectations. Yeah. Which you don't. That's crystal ball stuff, right? We want to look at where the business is at today. So that's why on the platform you'll only see trailing 12 months. But if you look right underneath
no crystal ball for you.
No crystal ball. Let's look at the facts. Okay. Let's look at the base data, not off of pie in the sky, what analysts or what the company is expecting will happen. But then the other one is PS ratio. That's price to sales ratio. And this is helpful if you're looking at a company that's not profitable yet, right? Sure. Because instead of looking at your bottom line, your net income, you're looking at the revenue. So that means just off of revenue, your price to your sales. So you take the same things. I'm going to use market cap. We'll just stay not on a per share basis. Yeah. So you take the market cap divided by total revenue. And that will tell you what the price to sales ratio is. That's a little bit more useful of a metric.
Sure. This is why it's so important for companies, especially ones that are maybe not yet profitable or not hugely profitable. So important for them to get bookings.
Yeah, right. Yeah, it tells you a lot. So that's when I like to look at PS ratio. Sure. And you can look at, especially if you're looking at a younger company, if you're looking at someone that doesn't have a lot of earnings, or you can see their strategy on how they're going to get earnings in 5 to 10 years as long-term investors, that's an okay horizon. Right. But you can still see what the value of it is today, what it's going to cost you to get a seat at the table in the company when you look at PS ratio. And then these other ones, price to free cash flow and price to book. Price to book is useful because you're looking at book value is just your total assets divided by your total liabilities. And I said divided, I meant subtracted. So total assets minus total liabilities. Math. That's useful. It's not you won't see it too often, but if you see that number being crazy high, you just want to take a look at why is this company's book value so low. Sure. And they can tell you maybe they're asshole deep in debt.
They have a ton of liabilities, right?
Yeah. And then you'd want to investigate that.
Sure.
And then price to free cash flow. That one's a little bit more tricky. It is a useful metric, but I'm going to keep this one more at the beginner intermediate stage.
Okay.
So that's the big thing about PE ratio. It's a static figure. It tells you a lot. It's one of the first things I look at a company when I start to analyze it. But it's definitely, do not let it ward you off of investigating the company further. Do not be dogmatic. Trust me, I've learned this one the hard way. I've missed opportunities that I've seen and I've seen other people miss opportunities because the PE ratio was too high, but they ignored the future earnings potential of the business. They ignored the growth strategy. They ignored anything else that could impact that.
This was great information because as somebody who's relatively new to all these metrics, things like that, honestly, what I look at mostly is the stock price over the last month, over the last year to see, am I going to make some money here? And is this on a good upward trajectory? Is it in a big dip and maybe I should buy now? It's great to have some of these, to learn about some of these metrics and know more about what they mean, to just be able to make more educated decisions and not just go off stock price and historical performance alone.
Yeah, and we're victims of our environment there because if you look at your brokerage, that's the first thing. I mean, even Flank's guilty of it. It's the first thing we put in front of you is the price graph, and that's just buying stock. That's just buying assets off of price action, and that's a huge misstep. And that's the whole reason why our platform exists, so that you can see the company holistically, so you can study the company holistically, so you can have steps that tell you exactly what you should look at when you study a business.
Great.
Yeah, so that's all about PE ratio. Elliot, what's that shirt you got on?
Oh, this whole thing? I was just waiting for you to ask. So as you might notice, this is my Beyonce tour shirt.
Oh.
My husband and I with some friends went to see Beyonce when she came to Washington, D.C. in July this year. And it was fantastic. And as a member of the Rainbow community, I'm required to talk about my tour merch and my concert experiences at least every few days, or else they'll take away my Rainbow card. So good of you to ask, because I was at risk of losing it.
That's true. Don't want to lose that.
Yeah, don't want to lose it, although I don't think I ever could. So the second thing I want to talk about today was something, that's been in the almost a monocultural moment, these mega tours, right? If my memory serves me correctly, before the pandemic, before 2020, tours were not nearly as big as they are now. Fast forward to now, when the world has opened back up and you can go to a tour now, it is incredible to see the scale and the size and just the prevalence of these mega tours. And for me, I'm really interested in how the money is made and maybe the non-obvious ways in which money is made. And tours are very interesting because, okay, yeah, like clearly the artist is making money, but how much are they making? How are they making it? And also, there's so many people involved. How can they possibly be making money off such a giant production? So I wanted to dig into that today a little bit and talk through some of the maybe non-obvious ways that these tours are making money. And I wanted to use the two that everybody thinks of, which is Taylor Swift's Eras Tour and also Beyonce's Cowboy Carter Tour. So while these tours are huge spectacles, they're also powerhouses for the artist, right? They make money hand over fist in multiple different ways. The first thing that everybody thinks of is, of course, ticket sales, right? You think, oh my God, they're making so much money off tickets. We all know how expensive tickets are and just how much money you can spend going to a concert. Trust me, I know how expensive it is, and therefore I'm eating only Lunchables for the foreseeable future. Honestly,
yeah. Fun fact: Elliot actually did bring Lunchables to shoot today.
I did. Yeah, I brought some Lunchables because I was like, I'm gonna starve if I don't eat something, and so I have millions of them. But so ticket sales are the things that come to mind. But when you think about how much money these tours are making, for example, Taylor Swift's Eras Tour made about $2 billion over her tour, and Beyonce pulled in almost $600 million in her 56-city stop. That doesn't just come from ticket sales alone. So I did a little bit of research on this, and what I found is that honestly, ticket sales are not really the main moneymaker. Artists are only making about 10% to 20% revenue off of their ticket sales, despite the absurdly high prices. Most of the ticket sales goes to the venue. Most of it goes to the ticket seller, as we all know. There's some greedy ticket sales companies, Ticketmaster. So they're not making a lot of money there. Merchandise, on the other hand, has a much better profit margin for the artists. And this makes sense because they push it really, really, really hard. The merchandise becomes not only a thing you can buy at the show, but it's something you see before the show on social media. You see it hanging up outside the venue, like what you can get when you're inside. You can get merchandise outside the venue. At Beyonce, they even had stands of trailers outside selling merchandise. The merchandise is pushed so hard. And as somebody who, when I get to a concert, I've already kind of spent my money. I don't really want to spend a whole bunch more money.
Yeah.
Which my husband was like that, but that's a topic for a different podcast. As somebody who's already spent my money, I get there and I'm shocked at how many people are buying merchandise. So I ended up buying merchandise, and now that I've learned this, it all tracks, right? The artist is making between 50 and 70% revenue off of these items that are priced absurdly high. Like this shirt, I think, was $60. There was an art book that was $100. You could buy a fan, which we also bought, for $35. So that's one of the interesting things for me that came.
Now, is that 50 to 75% of their total revenue, or are they getting 50 to 75% margin on that?
50 to 75% margin on the item. So if I sell a shirt if I sell an item for $100, the artist is going to get between $50 and $70.
Yeah.
As opposed to a ticket where they're going to get $10 to $20.
Yeah, absolutely. I love that you brought this up because that's one of the things that we as flankers do, right? We observe the world around us and we look at we study it, right? We study how how money flows. We study how people make money. We study, and then we look for a seat at the table. Where can we get involved in that in a way that we want to be involved in that, right? You vote with your dollars, both when you support an artist by buying their merchandise, but then also by investing in companies and giving them additional capital to be used to deploy to further their business interests. So you brought up Ticketmaster earlier. And Ticketmaster is owned by a company that I've studied for a while, and I got turned off because I saw the same thing you saw.
Nation.
Live Nation, the bum bum bum, and I saw the same thing you saw coming out of the pandemic. Live events were becoming huge, right? Massive, and I love it. I love live concerts. I love live venues. I love comedy. Yeah, it's great. And I wanted to, I see Live Nation tents all over the place, and I studied, and they own Ticketmaster wholly. That was something that I looked at, and I started to, they created an incredible flywheel that I made a post on.
Flywheel? What's a flywheel?
Yeah, flywheel is the idea that you create a system, you have your business model, right?
Sure.
That's why the first step of flank investing is how do they make money? That's just a simple way of saying what's the business model, right? And so what a flywheel is when you take that business model and with a great deal of certainty that if you can inject more into it, then the momentum, the inertia breaks on the flywheel and it starts churning, right?
Yeah.
Amazon had to make a huge capital investment to get their flywheel turning, but they knew that if they could own the distribution center, so they could have third-party sellers selling, who would help them, they would cover the logistics. You just ship, your product over to them. When it gets bought, they'll ship it out, right? That was their flywheel. And as that starts turning, that's when businesses start really producing cash.
Yeah.
And Live Nation's created an incredible flywheel because not only do they own they basically own every point of sale for a live venue. They own the ticketing. They own the concert promotion.
Yeah.
Which sometimes they'll lose money on the promotion because they give a lot of that to the artist. But then it's a reinforced cycle, right? Because then as the live event gets promoted more, and especially from a trusted face like a celebrity or an artist, then there's more tickets sold. So that's they make money on the top and they make more money in the venue, right? They own a bunch of venues worldwide, like House of Blues is owned by Live Nation. And then they have an artist management place. But then also, if you've been to a live event, you've seen all of the Live Nation tents everywhere. They have an interest in Liquid Death. Everything that is sold there under a Live Nation tent, they have some sort of interest in. So they have a captive audience.
That explains the prevalence of Liquid Death.
Yeah, exactly. Yeah.
It's
everywhere. If we look at the revenue for Live Nation, it screamed back. It got smoked during 2020.
Absolutely.
But then it just came roaring back. And it is declining. It's down 3% over the last year.
And honestly, reputation.
Not
to Taylor Swift reference.
Yeah.
But reputation alone, because people are so angry at Live Nation.
Yeah, and I agree. And that's what, as I studied the company, I looked into the CEO. I don't mean to throw shade on it. I didn't look incredibly hard, but I didn't like what I saw. I didn't like I feel like that, and this is the great thing about our no, there's good and bad about our capitalist system.
Correct.
But one of the good things is the chin of Live Nation has been exposed enough. People are mad enough that they do, there's a convenience factor. They have the flywheel built up, but they've stuck out their chin enough that the cement fist of a startup or a newcomer
The cement fist of a pissed off public. Also.
yeah, could absolutely come and we could see another company. I'm looking for that other company.
Yeah, that'll be yeah.
And some of the ones I've looked at, so you've heard of the Sphere, right?
Yep. In Vegas.
Do you know the Sphere is a publicly traded company?
Oh, really? I had no idea.
And I looked back at what the plan was. So basically, the Las Vegas Sphere was their first kind of step into proof of concept, right?
First thing. Yeah.
They already bought the land to build one in London.
Wow.
They want to build one in the Middle East, and the cost to actually produce more spheres is a lot lower. So I'm going to be going to Vegas tomorrow for my day job, but. We're going to go to the Sphere and we're going to watch a show.
Nice.
And if I see, if I truly think this is the future of entertainment, I think if I have an otherworldly experience during this, I'm going to be looking very closely at this company because I believe live events are here. They're here to stay. And I believe that, this it's a good business model to just take. You just know that if I have this amount of land, I can build a sphere here, I can build a sphere here, and your cost of production is going to go down as each new one is made. So I'm really excited to see it.
Wow!
But there's other ways we can get into live events too, right? If we truly have this thesis that live events are here to stay, Madison Square Garden is a publicly traded stock, which is actually owned or started by the guy who does the Sphere. So that's good when you're studying management. That guy is not just some newcomer to entertainment. He's a well-established figure.
When you go to the Sphere, watch out for that fan cam.
Yeah,
I don't want to see you on. I don't want to see you on the internet, David.
yeah. I'll be going with my beloved wife.
Good, great. Keep her very close.
Very clear. Yeah.
So that's merchandise, that's ticket sales, and that was really interesting in terms of the vertical integration, right?
Yeah.
Everything they're selling at the show ladders back up to the organization that owns it. The other thing that I thought was really interesting, that I've always thought was interesting, is partnerships, and it's so fascinating because they're very apparent in tours. One of the really interesting ones that I saw with Beyonce was, and I've seen a lot lately, is Citi Card. Citi is oftentimes the pre-sale. Like if you have a Citi Card, you get to do a pre-sale. Well, the benefits here are very obvious, right? Not only does the artist get to offset some of the risk by getting a sponsor like Citi to be like, hey, I'm Beyonce. I'm probably going to make a decent amount of money on my tour. How about you invest and, give me some stuff and I'll give you some stuff in return, right? So the interesting example for Citi is as the pre-sale, Citi gets a couple things. Citi gets more signups because people sign up for cards to participate in the pre-sale. You have to use a Citi card to get the pre-sale. So not only are they getting more signups, you have to use your Citi card, which means that they are getting assets. So then they're a credit card company, right? Or
it's a bank, but they have a credit arm.
Yeah, it's a bank. I think it was only credit cards, maybe. But anyway, they're getting that money, pretty large purchases, put onto their credit card. So they are raking in money both by not only the publicity of being affiliated with Beyonce, being the exclusive pre-sale provider, so getting new card signups, getting new accounts open for them, and lastly, getting more and more and more balances put on their cards and earning that sweet credit card interest.
Yeah.
This is the banking in me coming through because I'm like, wow, this is a triple threat, right? Publicity, new accounts, and earnings from interest.
So we can expect some Citi analysis on Flank from you soon?
I mean, definitely.
Actually, a word of caution to any individual investor out there. Studying a bank is really, really hard at first. I don't recommend starting with banks unless you're very good at balance sheets, or our friend Elliot actually works in banking, so he does have a leg up. But if you're coming not from the financial services world, I would recommend staying away from banking as your first step, or just be prepared to do a ton of research and understanding how banks actually work. A good example of this, if we look at the revenue for Citi, it's showing 0. That's not a data. It's a semi-data error from our data provider, who I'll go unnamed right now. I can't blame them. I actually reached out to them and complained that my banking companies weren't showing any revenue, and they gave a good reason for it. But yeah, they're beasts. So the banks are really hard to study, especially if you're starting out. But they're also very fascinating, and it'll help you understand. If you understand how a bank works and how a bank makes money, it will help you so much navigate our world, right? Everyone always says follow the money.
Right.
There's no better way to follow the money than through banks.
Literally where it lives.
Yeah, and you would see it. It's not even so much. I don't mean that conspiratorially. I mean that in the sense that a very large way that banks make a lot of money is through you owing them money from late fees, right?
100%.
And so obviously they're going to create their UI and UXs within law, right? Everything's going to be above board because they're also one of the most scrutinized, most heavily regulated businesses out there. But they're going to try to push so you are late on your credit card, and you can see why Americans are drowning in credit card debt.
Well, and with new things like buy now, pay later, they are capitalizing on those interest fees.
Absolutely,
Man.
yeah.
We'll certainly talk about banking
That's a
in the
future
future,
episode.
but it's a fascinating industry, and we'll definitely talk more about that in the future.
Yeah.
So I'll wrap up this segment with a silver lining. This is not all predatory capitalism. There's a lot of money. There's a lot of big brands involved. Obviously, there's a lot of people capitalizing, pun intended, on the fact that people want to go see one of their favorite artists live and want to have the experience. And don't get me wrong, concerts are an amazing experience. I think one of the most worthwhile things to do with your money.
Yeah, spending money on experiences.
Right, as opposed to spending money on things. And why not do both? Why not have the experience and also buy $200 in merchandise? But the silver lining of all this is that these tours are creating tons and tons and tons of jobs, and they're also having what has been described as a halo effect for the cities that they're in. Right, when these tours come to town, the economic impact is massive.
Yeah, the Fed reported this. Like the Fed, literally on their minutes, you can find it. They mentioned the Eras Tour having a material economic impact on the cities that Taylor Swift was visiting.
100%.
That's insane.
100%. And I mean, many of these cities, yes, are large markets like New York. Like New York doesn't need a ton of help in this realm, but some second market cities like Atlanta or second market cities like Charlotte, Raleigh, things like that, very close to us, right? They can really, really, really benefit from the tourism dollars that are brought in by these things. And this is things like hospitality jobs. This is like funding local nightlife. This is things like making better hotels, making better accommodations for tourists and travelers to overall make these cities more successful, more appealing, and just more well-traveled, which is good for everybody. So that is one silver lining and one reason I really like to see where artists are going, because it can really have an impact on the place that they're going.
Yeah, especially for any artists who are watching this, especially artists that we like. Come to Wilmington, North Carolina.
Wilmington.
Yeah, it's a great venue, great vibes here.
Come on down.
You'll have two people who will buy $200 worth of merchance at your show.
Literally.
So come on
Make
down.
sure your ticket is $30 and we'll buy $200 worth of merchandise.
Well, that was great. That was a great segment.
Yeah, thanks.
Again, that's what we do as flankers. We observe the world around us. And then we have the curious interest to go look into how does Live Nation make money? What is this? I mean, what percent of people do you think that know that Live Nation owns Ticketmaster outright?
Yeah, right.
I would guess less than 1% of people, right? And that's when you start studying these things, when you start actually following the money, the chessboard makes so much more sense.
Yeah.
And I'm perplexed that Flank is the first company that wants to do this. We really don't have anyone else who says follow the money, do it like in a non-conspiratorial way. Actually do the research. You're capable of doing this research, right? Buffett said it's not a matter of intelligence, it's a matter of emotional temperament. You don't need to be an expert. You don't need to be some 3D chess player in order to do this stuff. We can all do it. And if you want to learn how to do it more, come visit flankinvesting.com. Give you a shameless plug right there.
Flankinvesting.com.
Yeah, and it's free to get started. So we hope to see you over there. That's all for this episode. Again, thank you so much for watching. We'll be back next week with a new episode. Thanks again so much for watching, and we'll see you then.
Bye, everybody.